In this video, I'm going to talk about what are Golden Cross, Silver Cross, Death Cross, and the Hindenburg Omen. Stay tuned. Hey traders, a very warm welcome to So what are Golden Cross, Silver Cross, Death Cross and Hindenburg Omen? Traders, investors, market analysts, participants, all that have funny ways of making up bizarre terminology for stuff. So let's run through what these things are. You might have heard them, you might have not heard of them. Do they mean anything? Let's have a look. So the Silver Cross and Golden Cross and Death Cross, these are all based on moving averages crossing over each other. So moving average is pretty much, as we already know, is just an average of price over a specific length of time. So the average closing price over the last 50 days would be a 50-day moving average. The average closing price of the last 200 days will be your 200-day moving average, and it updates every single day. So a silver cross is when the 50 crosses the 100. In other words, if this is our 100 period moving average, let's use a different color pen here. And this is our 50 period moving average. Let's go with a red pen. If the 50 crosses the 100 period, just here is our silver cross. To the upside, it's got to be an upside move to be a silver cross. Golden cross, very similar, except the 50 is crossing the 200 to the upside. And these are named that because they believe that this is the start of a good trend. A golden cross, obviously, supposedly more powerful than a silver cross. Whatever, you can kind of look at it and make your own assumptions from that. Death cross is when the 50 crosses the 200 to the downside. So it's seen as, ooh, bad for the stock. It's crossing over a kind of long-term average price for the stock. It's crossing down below it. That's a death cross. What you should do with that, I don't know. The theory is bad for the stock, come out of your positions, exit your positions, and what have you. The Hindenburg Omen is a little bit different, and I've not quite nailed down exactly this number here. We'll talk about it in a second. The idea is that the number of 52-week highs and the number of 52-week lows should be greater than 2.2, and I've had some people say 2.8%, but around that figure of the total number of stocks in trading on the day. So on the New York Stock Exchange, if you've got how many thousands of stocks trading, if more than 2.2% of those are trading at new 52-week highs and more than 2.2% of them are trading at 52-week lows, it's considered confusion, or it's considered, people don't know what's going on. There's a lot of mixed stuff going on, and there could be a market crash that comes with that. So are these things any good? You know what? You got to make your own judgment on it. If you're trading a moving average crossover, does it matter if it's called a silver or golden? No, maybe you should be paying attention if you're looking for trending type trades. If you see something that's the 50 is crossing the 200, maybe that's of interest to you and you need to take a closer look at it. Does it mean the stock's going to immediately rip up and give you a 25-30% gain? Probably not, but people like to label it as stuff. Same with the death cross. Just because the 50 crosses the 200 doesn't mean the stock is now going to go bankrupt and the company's going to go under. I doubt it very much. But you know what? This is the kind of labels that people put on stuff. So if you see it next time in the media and you see Golden Cross, it sounds better than it probably is. It's just an average, slow moving average being crossed by a fast moving average. Same with this Hindenburg Omen. Again, it's just kind of some things that have happened and people made rules out of it. There you go, guys. Silver, golden, death, Hindenburg. Hope you enjoyed it. Stay tuned for the next one. Keep the risk managed. Goodbye.